The Fed releases the minutes of its September meeting later today. Looking at the markets right now, it's green across the screen. Our next guest says the direction of interest rates in the coming decades will be critical as value investing may be favored going forward. Joining us from San Francisco is Michael Grant, Co-CIO, Senior Co-Portfolio Manager, and Head of Global Long-Short Strategies at Calamos. So you say this is a turning point for growth stocks, and I think we all started to feel this with the kind of great rotation that we had in September out of momentum. Do you think that is going to continue to be the state of play?
Well, it certainly could be. The momentum factor is well known for its severe drawdowns, but what's intriguing is that those drawdowns very often occur at periods of market dislocation. For example, they became quite frequent in 2000 at the peak of the internet bubble. They became quite frequent in 2007. Many viewers might remember the quant quake in August of 2007. So the kinds of drawdowns that we saw in early September have historically been associated with key inflections in the investment regime. So it's too early to say that we've seen it, but I think investors should be considering whether we are seeing the beginning of the end of the leadership of that growth momentum factor.
So if it's the beginning of the end, I mean, where to go? What is your favorite thing right now?
Well, the key is to understand that most of the winners across the equity world post-2008 have been derivatives of the duration theme. In other words, they've been the beneficiaries of this long period of capital subsidy by central banks. For example, the equity regime of the past decade has favored the disruptors rather than the incumbent disrupted. And it's important to understand how important a free cost of capital is to allowing disruptors to win. In effect, most of these companies require long periods where they can develop dominance without having to monetize their market position. So many of these themes are heavily reliant upon a low or artificial cost of capital. And to the extent that that changes in the next decade, that will have a decisive impact on the winners and the losers.
Hi, this is Tendai Kafizo, Lending Tree. So you mentioned the low cost of capital, and now we have the Fed cutting, or maybe in a cutting cycle. We don't know how far that will go. But we also have corporate debt, at its highest share of GDP. It's a record high. So, I mean, does that concern you in terms of, is the corporate debt right now too high? And does this bode poorly for risk in the economy?
Well, I think that's a very good point, and it's why we're not there yet vis-a-vis a switch from growth to value, and it's why I described it as the beginning of the end. What we've seen this year has been an almost frenzy of duration, and the peak of that frenzy should occur when the risk of U.S. recession is fully discounted, probably in the next 3 to 5 months. For now, one of the problems that the value sector has is that they typically do have higher levels of debt, and of course that's a problem when the market is concerned about recession. But the point here is that this long outperformance by a certain type of equity class that benefits from low interest rates, we are within striking distance of the end of that long outperformance.
Michael Grant of Calamos, thank you so much.
Thank you.